backdrop of the labor market is still quite weak, or one reflecting a weakening labor market. So the US, they have a dual mandate. The language and the tone and the messaging is going to be key to watch this week as to whether they actually do flip and sound slightly more hawkish on back of these inflation shocks that are coming. Now, let's also switch over. I wanted to take a deep dive also into some of the local stock market indices, going back to the beginning of the war. And what you can see from this is there's been dispersion and somewhat, I guess, not really that counterintuitive, but actually the Saudi Tadawul is up 4.5% since the beginning of the war. Obviously very energy heavy, and the market's still accounting for the fact that maybe the higher oil prices could benefit Saudi Arabia. But at the same time, you need to think of the production cuts that they've introduced of around 2 to 2.5 million barrels per day, per our latest reporting. But then take a look at the blue line. That is the Dubai stock market, down almost 15% since the war began, and actually down more than 20% since its February highs, and does suggest that the financial services sector, real estate, some of the worst performers on the Dubai stock market have been Ahmad, which is the main property developer, are really taking a hit the longer this war goes on. So this is just a snapshot of some of the local stock market indices. You've got the Doha Stock Exchange down 2.3%, and then the Tel Aviv index down 3.3% since the start of the war. Now, let's go back to the latest geopolitical developments. President Donald Trump has reiterated his appeals for other nations to help secure the Strait of Hormuz as the war continues to roil oil markets and global shipping. Trump has voiced his frustration with nations that have been publicly non-committal about helping.
We strongly encourage other nations whose economies depend on the Strait far more than ours. And we get less than 1% of our oil from the Strait. And some countries get much more. Japan gets 95%. China gets 90%. Many of the Europeans get quite a bit. South Korea gets 35%. So we want them to come and help us with the Strait.
Allies of the US have deflected Trump's demands, expressing unease about getting pulled into the war in Iran. Japanese and UK officials won't commit to a naval mission, with the EU taking a similar stance.
The discussion on whether we are, also extending this mandate to cover the Strait of Hormuz to go north from the Muscat line, there was no appetite from the member states to do that. As I said, this is nobody wants to go actively in this war, and of course, everybody is concerned what will be the outcome.
For more, we're joined by Stuart Livingston-Wallace, our executive editor for MENA and Russia, and Bloomberg Stan Williams, live from Jerusalem. Stuart, I want to start with Trump's efforts to build up this coalition to help secure the safe passage of vessels through the Strait. Doesn't seem to be yielding a lot of fruits at this point. And I thought it was really interesting. We just heard from Kaya Kallas there from the EU, suggesting that they see this as them being pulled into the war. And I think this is perhaps the perception that he's going to have to overcome.
Yeah, and I think it's a lot more than a perception. I think it's the reality. As far as we can tell, there was virtually no consultation with any of the international allies. The administration spent many months questioning the utility of NATO, the utility of the European powers, and then decides to start a war in which it now finds itself somewhat, in a difficult, tricky circumstance when it comes to Hormuz. And then it asks them to join that war. And so I suppose from that perspective, there's not a lot of upside here. Now, he is quite correct in saying that the US is far less dependent for its energy supplies than many other nations when it comes to this particular choke point, maritime choke point. But that has been the maritime order really for the last several decades. And the deal was that the US would guarantee shipping lines in return for which it would have, a preeminent voice in the world. So you understand their reluctance.
Yeah. And Stuart, let's just turn to, again, more developments overnight. More key infrastructure, energy infrastructure within the UAE has been targeted once again by Iran. Walk us through the latest.
So, I mean, it's sort of a continuation in some respects of what we've seen over the last several days. So, Fujairah, which is sort of the port in the UAE that would allow shipping to bypass Hormuz, that has again had an incident, and you're seeing this right across the region. So, the targets in effect have shifted somewhat over the last week, more into sort of the infrastructure side of things, and that is fairly widespread. So we'll see how this goes over the next couple of days, and again, that may change again.
Break even.
So it must be said that the Gulf
We need to
nations have
wait
been,
for price to, if price
terms
can
intercepting a lot of these attacks.
displace
Yes, a few
to
things get through. Yes, you do have
this
definitely that
volume level,
all over the place, but nonetheless, there's no sign yet that we're going to get a let up.
displace, we take this value area,
The impact.
this value.
Dan, let's talk about the other parallel front. Yesterday, the IDF announcing that they're expanding their ground operations in southern Lebanon. What do you know about
This.
Good morning. Yes, Israel is fully a partner in this US-led war on Iran, but for many Israelis, that conflict 1,000 miles to the east is being eclipsed by the second front of this war, as you noted, the Lebanese front with Hezbollah, an ally of Iran, which had been quiet, but 2 days into the Iran war, reignited that front with a volley of rocket fire against Israel. The Israelis have been building up forces in southern Lebanon dramatically. I was told last week there are around 1,500 troops there. Now we hear it's more than 2 divisions worth. That's upward of 20,000. The official Israeli line is that these troops have been moved in to prevent what they say is an attempt by Hezbollah not just to be firing rockets above Israelis' heads into the Israeli home front, but to send hundreds of fighters to the border to attack frontline Israeli homes, as was the case in fighting of 2023-2024. However, this buffer zone, as the Israelis are calling it, appears to be deepening
Next
dramatically,
level here.
potentially all the way to the Litani
These
River.
bears, if bulls can displace, take out this bear level,
About 10%
I'll look for
of
another
the
long
territory,
setting.
where the Israelis ordered out hundreds of
And
civilians.
here, take this, swing back to Pio's
It would appear
value.
the Israelis are
Okay.
going to reestablish in some form their so-called security zone, the occupation zone that was in place in southern Lebanon between 1985 and the year 2000. The big question on everyone's minds is whether this can be prevented perhaps by a last-minute diplomatic deal. The Israelis have been indirectly in touch with the Lebanese government, which undertook last summer to domestically dismantle and disarm and distance Hezbollah from that Israeli border. That hasn't happened. It would appear that behind all this martial music, there is still some attempt to get Lebanese authorities cracking down on Hezbollah internally.
Sturgeon Wallace and Dan Williams? Thank you so much. Now, oil is jumping this morning on the energy attacks in the Gulf by Iran. Let's discuss further with Junaid Ansari, a director of investment strategy and research at Hamco Invest. Do you have a scenario analysis that you put together, perhaps on where you think oil prices could head to the long? Indeed, multiple attacks on energy infrastructure sites in the region.
Good morning, and thank you for having me, Romana. So the best case scenario for what's going on the geopolitical front in the region would be that a gradual reopening of the Strait of Hormuz. So because that is the nerve center for trade in the region and for the passage of crude oil from the region. What would this result in would be a slide in oil prices. We only say slide, but oil prices will not crash. We believe that in the near term, oil prices are not going to go back to the $60 per level. It will continue to remain elevated between $70 and $80 per barrel. And in fact, in the immediate term of a ceasefire or of resolution of this or stability in the region, it will continue to remain above the $80 per barrel level. And the reason for that is there are the crude oil strategic reserves that the globally countries are using, that has to be replenished. That's one. Second, there will also be a hold towards building new reserves, anticipating any kind of attacks, anticipating any because this brings in a lot of reality check as to how much amount of crude oil is required by each country. So that would cause oil prices to remain elevated, production levels to remain elevated for global oil producers. I mean, if you look at the OPEC producers, the buffer capacity of close to 4.2 million barrels per day, that would unwind. There is a buffer capacity with Russia that will also unwind. We've seen that Russia is being given some concessions by the US to sell their oil to some of their trading partners. So these are some of the things that we're expecting on the crude oil front. We also believe that trade will open in the Middle East region. That will ease some of the inflationary pressure that we are expecting in the near term. And in terms of economic impact, we believe that interest rates are expected to remain elevated. It may also the central banks may also raise interest rates. We can expect some messaging day after tomorrow after the Fed meeting. But ECB has pretty much said that probably they'll be looking at raising interest rates in the near term. So this is sort of a best case scenario what could happen.
Okay, let me just go back. Yeah, that seems the best case scenario. But in the scenario where, say, the Strait of Hormuz remains effectively shut for a few more months, how do you see the oil markets reacting, but also the global knock-on effect as well to many of the economies that you just spoke about?
So that is kind of a worst case scenario for us. And although people are talking about crude oil prices, but the price trend in the refined product segment is being enveloped by the news on the geopolitical front on the crude oil side. Prices of jet fuel has doubled in some of the markets. Prices of gas oil have also doubled with some of the markets. The bottom of the barrel products are also facing the heat. Petrochemicals, naphtha, fertilizers, these have direct impact on food. So that will also be facing a lot of inflationary pressures. For instance, the shortage of diesel in Brazil has caused soybean prices to go up. So these are some of the immediate impact of the closure of the Strait of Hormuz. And then there is also the rising cost of insurance. I mean, if you look at the vessels passing through the Strait of Hormuz now, the cost has gone up by 5% for them. So in the worst case scenario, inflation is expected to remain very high, and in most of these markets, there will be a GDP impact for the markets in the region as well as globally. Yesterday, I believe the chief economist of IMF, Gopinath, also said that global GDP could be impacted by 60 basis points if because of what's happening in the Middle East. So definitely, Saudi GDP impact will be limited in the region, but for the rest of the region, the impact will be much more severe. And these are the things that we're expecting if things to go down south.
What's your favorite thing about? I did a look back at how some of the key stock market indices of the region have performed since the war erupted on February the 28th. And one thing that stood out to me is the Tadawul index in Saudi Arabia is actually tracking positive since February 28th. Obviously not the case for the likes of Dubai, which is the stock index there is down 16%. So what do you make of this divergence?
So there are two key reasons for that, Jomana. One is the share prices of Aramco has because it has a 15% weight in the TASI index, and Aramco share prices are up since the war. So that is also supporting the performance of TASI at the index level. However, even if we exclude Aramco from Saudi's performance, so how do we do that? We look at the market cap of the Saudi market. So you're right that the market cap of Saudi market, excluding Aramco, is up by 0.7% since the start of the war, and this shows that this reflects basically the relatively lesser impact on Saudi Arabia from the war. That's one. And secondly, Saudi Arabia is able to reroute close to 5 million barrels of crude oil to the Gulf of Oman. So that also is in a way sustaining the Saudi economy. They will and plus, despite the decline in oil shipments in Saudi Arabia, the increase in prices of crude oil, I think that will offset the overall decline in volume. So in a way, Saudi may be in maybe lesser impacted, severely lesser impacted as compared to the rest of the GCC market. And this is precisely what is being seen on the index or on the financial markets.
Junaid, thank you so much for joining us. Junaid Ansari, Director of Investment Strategy and Research at Camco Invest. Well, still ahead, we talk recession worries and concerns around private credit alongside the global energy ramifications of the Iran war with Jean-Henri Mochot of Banque Suisse. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Asian equities in the green today as NVIDIA's upbeat outlook for AI lifts sentiment, but investor focus remains on ship traffic through the vital Strait of Hormuz, and crude oil is hovering just above $100, as you can see. Joining us now is Jean-Henri Mochot, Banque Suisse CIO. Jean-Henri, I observed at the top of the show that I guess markets can only focus on one thing at a time. And this morning, the story is about NVIDIA and the fact that they're projecting revenue of more than $1 trillion by the end of 2027. So is this it then? The concerns around the Iran war have been pushed to the side because of some optimism that has emerged again around the poster child of AI?
Well, I don't think it was purely AI related. I think that the market currently expect one thing, to see the number of vessels going through the Strait of Hormuz just picking up. So the fact that we have moved from 2 or 3 vessels to maybe 4 and 5 was enough for the market to start to position for recovery. It looks like investors have been trained to position themselves ahead of a FOMO or a taco trades, and they don't want to miss the recovery. So that's why we have this optimism in the market for timing. On our side, we think that it might be too much of complacency. We think that there are other scenarios which are less appealing, and that the market is not a position for these scenarios for timing. So AI news coming from NVIDIA was probably, let's say, a good reminder to us that it's not just about the Strait of Hormuz, but I think that this is the obsession of the market, and that if there are signs that it's picking up, it's going to be good. If there are signs that it's going to be a long-lasting conflict, then maybe the market will have to readjust.
I mean, I'm just referring to a scenario analysis that our Bloomberg economics team, Ziad Dawood and Dina Svenderi, put together. And this is sort of the framework that I think about things. They said if the strait stays closed for a month, then you get to oil prices around 105. If it stays prolonged disrupted for, let's say, 3 months, you can get prices north of $150, $160. Doesn't that change the backdrop for the entire global economy if oil is trading at $150? Just not just in terms of energy impact, but supply chains. And eventually you're going to have to think about demand destruction and the growth hit too.
I fully agree with you, Joanna. And this is why, using scenario analysis, we came to the conclusion that these alternative scenarios, which are going to have some impacts on GDP growth, on the downside, on inflation, on the upside, but also in terms of the tightening of the financial conditions, because the longer we have the dollar going up, the more it's going to tighten also the financial conditions, also through the credit spreads widening. So we have to adjust to the reality that maybe the rosy scenario of January and February, which was Goldilocks, is progressively moving to a scenario which is closer to stagflation, with then the ripple effects leading to recession. So we need to take this into account. And again, as mentioned before, it is not priced by the market. On our side, this is why we reduce our overweight equity position to something which is closer to neutral, because we don't want to take a bold bet on a very uncertain scenario.
Yeah, I mean, I remember the conversations that we were having, not just with you, but with other investors that I speak to. Asian equities, there was a lot of excitement about the opportunities that Asian equities were going to offer this year. And indeed, for the first couple of months of the year, we saw a huge outperformance there. Do you think the energy crisis changes things because so many of these Asian economies are net oil importers?
I absolutely agree. And also it changes let's say, the outlook on cyclicals. And this is why on our side, when taking some money off the table, we chose to reduce the allocation to Asia, to reduce the allocation to cyclical stocks, while sticking to the US and some of the more defensive sectors of the US, because indeed the US is self-dependent. They are net exporters of energy. And this is why, for the time being, they are outperforming the rest of the world, with the exception of China. Now, there is maybe something that could be a bull case for the market that we need to take into account, and we're starting to develop, in the sense that maybe we might have no ceasefire between US and Iran during months. But at the same time, some countries are starting to negotiate directly with the US. We saw that yesterday. There were rumors that Italy, Spain, India, and obviously China are in direct contact with Iran, and they try to get their vessels going through to get their oil. So this is maybe the bull case scenario that we need to take into account. But if it's no ceasefire and full blockade, definitely the Asia trade is going to suffer.
Yeah, and let me just pull you in one other direction, because it's a big story in the US. And what we've been seeing is a reassessment of private credit exposure for many of the private equity firms. I wonder as well how that's going to add to the overall picture for risk in the next couple of months, and whether you actually see, the combination of an energy shock and a private credit shock formulating some form of, catalyst for systemic repricing of credit.
This is exactly the point, is that if we take this private credit issue in isolation, it's probably good enough. But on the other hand, if you add this to the fact that the economy is slowing down, and that there is also more and more uncertainties with investors, that there is the start of, let's say, a confidence issue, then things can start to snowball. On an isolated basis, these credit issues, these alternative asset management stocks, they are trading down on headline. The issue is more a distribution issue, the fact that these funds are semi-liquid, and that some retail investors suddenly realize that they will not get all of the money moved. So it's more a distribution issue.
That again.
But the more we get into the scenario that the economy is starting to slow down and maybe head into recession, the more pressure there will be on these credit names, and also the lower
Rejected the IB level.
Yeah.
Cannot displace them.
To chat to you. Thank you so much. Charles-Henri Monchot, Monse's CIO. And coming up, we're going to continue the conversation, speaking to Toppner Stoffelt, principal Middle East analyst at Verisk Maplecroft, on the impact the widening conflict is having on global economies.
Excuse me.
This is Horizon's Middle East and Africa, our top stories this morning. U.S. President Trump reiterates his demand for help in the Strait of Hormuz, but allies are less than convinced, refusing to get dragged into the war. Iran steps up its strikes on energy infrastructure in the Gulf, with operations at the Shah natural gas fields in Abu Dhabi suspended after a drone attack. Plus, oil jumps as investors keep an eye on the Strait of Hormuz, and Asian equities rally as Nvidia's upbeat outlook for artificial intelligence lifts sentiment.
And able to get some decent moves this morning during pre-markets. We had one good trade, and then the rest were just break even. Couldn't get anywhere. Tomorrow is going to be preparing for tomorrow now, Wednesday.
What if you could transfer
PBI at 8:30 in the afternoon.
complex market
JP
dynamics,
the Fed.
macro and geopolitical shifts, and regulatory hurdles? These are the challenges
Expecting rate cuts. We'll see.
as they work to shape compelling narratives, address concerns from diverse stakeholders.